This is Tom Aspray with the Viper Report Market Wrap video for the week ending July 18th. It was generally a positive week for the markets, led by the Nasdaq 100 up 1.25%, with the utilities up 1%. They had a strong close Friday. The S&P up 0.6. The Russell was higher, erasing some of last week's losses, up 1/3%. All the other market averages that we follow, the New York Composite was down barely. Industrials were down barely. The gold was down 1/4%, and the transports were hit the hardest, down 2 points. For the week, the breadth was negative, but as you can see here from this weekly chart of the SPY, the higher closed. We took out the doji high from last week, so that's a good sign. We also show that we're getting fairly close to this R1 level for the SPY, 641.98. So that's not 14 points higher in the S&P. So that is a couple percent is all we're below it. Down below we have the S&P 500 AD line. Rose slightly, so that indicates even though the NYSE breadth was negative, the S&P breadth was slightly positive. Stocks only declined, as did the all, but both have clearly broken out. So at this point, if we're going to see a correction, back to the breakout level and the moving averages is what we'd be looking at. It was another good week for growth. You can see the IWF IWD ratio powered up. It was up a couple percent almost, showing that once again growth was leading. XLK did add another good job last week. The MACDs for the ratio are rising very sharply, suggesting that it is probably too early to look for a rally failure at these previous peaks. The QQQ also had a good week. You can see the weekly chart. It's getting very close to its yearly R1 at 272. So when it comes to this sort of stage, we'll look at the daily as well as the hourly ones as we get closer to determine whether you want to take some partial profits. The AD line, slightly higher, but it's been leading prices higher for some time. So at this point, it doesn't show any signs of a major top, though. It's at 561, and the 20-week EMA is at 519. So if my math is correct, that's about 42 points below it. So that's a good 6-7% gap. This is a new indicator I've been working on. I'll be writing up something on it, but basically it looks at when the spread starts to widen in the bond market, which often is a precursor or gives you a warning of a correction. You can see that back here in the start of 22, spread, it was narrow, started to widen. That was the decline that took us into the June low, rally up into August, and then the final low here where we got a bullish divergence because you can see it made higher lows and the S&P made lower lows. Also early this year, the spread was quite narrow and tight. It started to widen out here, February, and we got the April correction low. We got a drop right back down into, pretty severe drop. You can see that it hit the S2 in terms of a pivot level, which was quite interesting, and has since moved back into positive territory. So more on this in future videos. In last week's sentiment data, there was a pullback in the number of bulls and a rise in the number of bears. So the bull-bear ratio closed at 0.3. So obviously well off its worst levels, but still in an uptrend. So we're looking at it, if the bullish number was to drop below about 32 and stay there for a couple of weeks, that would suggest that the sentiment has rolled over. That's not my current view, and so I'm looking for it to still move higher as we head into the end of the summer. The daily chart of the SPY shows that we're getting pretty close to the R1 at 630.27, and once above that, 642.69. So pretty much the moving averages are acting what you would like to see. Particularly the 20-day is still rising sharply. Pullbacks to it or slightly below it should still be well supported. Typically what happens before you get into a top, that relationship narrows and the 20-day EMA starts to flatten out like it did in the early part of the year in February. And even though we made a new high, the 20 period here was not, and of course both started to decline at the end of February and that before that correction. So daily AD lines are positive. We'd feel a lot better if they were at new highs of the week, but so from here, the weekly still suggests they're going to move higher. However, if we were able to drop below last week's low and the moving average, then we could see that 2 to 4% maybe correction, taking the AD lines down to first of all the high from early May and then this support line A. So S&P is acting the best now. Stocks only turned down, but it also has started to catch up or lead in the last couple of weeks, and the stocks, the all ADs forms convincing higher highs, turned down slightly. So on a real short-term basis, higher numbers on Monday will kick it back up. Lower numbers will kick it down if they're like they were on Friday, say with 1100 up and 1700 down, then we could drop back to the test this support. The outlook for the QQQ daily, also it shows you it did hit the R1 here at 564.50. 577.35 is the monthly R2. As I mentioned just a little while ago, that the yearly R1 is in the fourth range. So that's if we get another sharp rally phase, that's where we'll be looking at. You can see that the pattern in the NASDAQ 180 line, though still positive, doesn't look quite as good as some of the NYSE or the S&P, because it's still showing this little pattern of lower highs. So we'll see how that's resolved. It's got a lot of really good support here, down in this range, and then of course the uptrend. So no signs yet of a significant top, but correction is always possible. Relative performance, still a market leader. That's what we like to see. Still no warnings from the high-low analysis, though the new number of new highs, the recent peak was just below 200. It's certainly diverging from what we saw towards the end of 24. On a short-term basis, it does not indicate a correction. We're holding new lows at 33, so we start to see the new lows creep above 100, 150. That might be more negative. That especially would be the case if we see that in the NASDAQ composite, since it often turns sooner. You can see that we're a little bit below the early July peak, but one day could easily push this back up towards the 350, 400 range. Really low. You can see going all the way back into May, we've had like 70, 80 new lows at the most. So no problems there yet. Option indicators still suggest, buying calls. You can see the overall 0.74, it's getting down to the ranges where, got down here to under 0.65, I think, in May. And this is for the indexes. We got above 1 here, before that one couple of day sell off on fears over Powell getting fired, but generally still suggests not a lot of bearish sentiment out there in terms of put buying. Both the VIX and the VXN volatility measures are still in downtrends. That's positive for stocks. You can see, we've had a couple of different blips, so now we have these two peaks up here. Resistance looks like right around the 22 level, and the VXN, which measures the volatility in the NASDAQ 100 options, it almost acts weaker. You had sharply lower highs here, so you can complete a downtrend here. So, a break of that downtrend would be the first sign of a rally. You can see, that's what we got in February. In late February, they both turned higher here, and that was the correction that went, spiked up here all the way up, to a high of over 50 in the VIX in early April. And when you see that sort of thing, and we talked about at the time how low the bullish sentiment was, or how high the bearish sentiment was, that's a sign that you're getting close to a buying opportunity. And the daily AD numbers kicked into gear in about April 23rd or so. Let's look at the ETF list first. You can see we had weekly negative DTS in the iShares Medical Devices, IHI, NTLT, that's a Treasury bond, XHE, that's the Health Care Group, and a positive on TBT, that's the ProShares Ultra Short T-bond. So that's a sign, of higher yields, and just as TBT confirms that view. One thing I never talk about too much is that when you find two markets that go in the opposite direction, you like to see them confirm each other. In other words, if you're looking at a triple short ETF and a triple long ETF based on the same, like on the S&P, you expect them to corroborate their signals. So if you're looking at negative OBV on a inverse triple leveraged S&P ETF, you would expect to see positive OBV on the triple leveraged long. Scrolling down here, we can see the market gauge is at 85.5% above the quarterly pivots. You can see cloud in the growth sector just flipped positive. Only negatives are, we have a negative daily in the ITB, the home builders, and good old healthcare is negative across the board. So pretty strong numbers, 90% above the pivot, 90% weekly positive, 80% daily positive. And if you look down at the value, it's 100%, but look what happened on Friday. All these value flipped, well, most of them. XLI didn't, but are red heading into the end of the week. So we have the KBE, the bank, KRE, the IWD, the value measures really took it, and that's an interesting thing. Not much change, so you still be in the short, out of the short ETFs and in the leveraged long ETFs. We took some partial profits on strength in the TQQQ and are targeting another profit taking area in that one. Those are the only positions we have. When I saw these numbers, I thought it was quite interesting, so I wanted to take a look back at in time and look at what the numbers showed us in the summer of 23. So this is as of July 30th, 2023. If you go on the Vibe report, you'll see we had a negative reversal in the stock market, I think on the 27th. And, you can see the numbers are really high then. And if you look down the road, if we fast forward to August 19th, 2023, a little over 2 weeks, you can see only 46.3% were above their quarterly pivot then. Look at all the weekly sell signals that had emerged. And, we were seeing, not a lot, all the green were in the inverse ETFs at that point. So interesting. If we get up to some of those resistance levels and get closer to the weekly Stark band, that suggests the market, could be closer to, a meaningful correction. We'll stay on top of this and let you know if we see any more conclusive evidence. Looking at the sector report, you can see there were some pretty amazing, significant shifts from week to week. Energy dropped down to 66.7. You can see SLB, ExxonMobil, got a 3-day, so still a bunch of positives here, but as I'll probably talk on Monday's report decline, the chart of the crude oil futures does not look that great. And these look promising last week. I think I commented to that effect. We moved back above. Remember, this is the short-term moving average. The longer moved above the longer term, suggesting a bottom was forming, but right back on the downside for both the energy and the materials last week. So only greens here were some of the chemicals, and certainly Newmont, got a negative DTS. We had a pretty tight stop, and there was a downdraft, a light market looking decline that took, cleaned out our longs. So we're on the sidelines there. Industrials still look strong. Lots of red here, though. So these are the leaders: are GE, Caterpillar, Honeywell, ETN, Boeing. So CSX. So if we think this is going to continue to move higher, then we should start looking at some of DE, ADP, CAT, etc., UPS, and UNP for some green to develop. Consumer discretionary also had kind of a reversal. It just moved above its moving average, back below it. Tesla gave a 3-day, so it's been a drag on that overall market. Amazon is green, so that bodes a bit better for the ETF. But still, we have MCD rather, McDonald's. Nike is green across the board. Home Depot and Lowe's are back to weekly positive. It also declined. I think, I don't know where it was, 66.7, went from 75 to there. Consumer staples still acting weak, and there are just acting weak. Target, and Dollar General. Not much sign of life here yet from Costco or from Walmart. And healthcare, still on life support. 72.7% are positive DTS. MDT is positive. J&J had a really good, strong close for the week. Pfizer did also. Bristol Myers. So I'll be looking at that chart maybe in case we're going to, see a flip there, and TMO as well. But chart doesn't look that great. Financials. You look at the XLK or the XLF rather, looks pretty good. I just recently recommended on a pullback, quite a few good earnings rather, from some of the banks. So we'll see if that continues next week. Technology, 66.7. It's one of the better ones. CRM just gave a 4 hour, so you can see where the negatives are here. So those are the ones we'll be watching next week. Adobe, Intuit, etc. Cisco. Communications, 41, so it cracked the 50 level. So that's something to pay attention to. It could drop back to that more major support, from the most recent lows. So lots of red here. If it's going to turn, we should see some improvement in here. Utilities, I said, had a really strong close, and we're still in the XLU. So EXC flipped daily. The 3-day is already positive, but the weekly and the quarterly are not. XCL, SRE, you can see all three of these, shifted to positive last week, as did WEC is weekly. So, but most of the relative performance on these things, communications here, it broke to a new low here, while technology still looks strong and making new highs. And if we look back into the breakdown, robotics still look pretty strong. AAII mix, 71.4%. So my thanks again to Jerry for he dug up some of the components of these that are not less necessarily widely followed, but given his cybersecurity, DDOG is a long position we've got in the stock service, crowd, FTNT, etc. Future Med, 37. Okay, so normally you look for above 50%. So genomic gauge is 50%. Nothing emerging right in that group. Neuroscience, 50%. Still lots of red. The self-drive, you can see that's where it's coming in, the DTS, and the 3-day here is also looking much more interesting. Lithium is positive, and if we look in the energy transition, also some pretty good signs. 75%. Electric utilities, 44%. Ground transportation, 60%, but still a fair amount of red. So are we going to see CSX, one of the train stocks, are we going to see it start to pick up? Because NCS here is also green, but we have UNP here, which is still just flipped to a 3-day DTS. Lastly, moving down, retail, Amazon and Target leading the way, and hotels and leisures, they're looking pretty good. We're actually in Marriott, so we'll see how that panned up. But you can see Hilton, is looking pretty well, and MGM Grand, the casinos, infrastructure, aerospace, also 75. So these are all positive looking groups. 100% the NQ largest. So you can see there's hardly, Meta is one of the few that's starting to see some words. And interestingly, as we'll discuss in today's reports, it also triggered a weekly doji sell signal in Meta. So it might be an early warning. And then lastly, the Dow, is starting to be pretty sluggish. So, both Home Depot and McDonald's closed below their quarterly pivots. Weekly, 3-day negative for McDonald's. And down here we have next week on the economic calendar, we have the leading economic indicators on Monday. Fed Chair Powell is giving some opening remarks. So given all the controversy around him, that may come up. I think it would tank the markets should he decide to cut his term early, or if somebody fires him. Not a great idea, my view anyway. Services PMI, manufacturing PMI, new home sales, and durable goods on Friday. Then the following week, the calendar is much more crowded at that point. Well, that's all I have for this weekend. As always, send me your questions and comments to tom@viperreport.com, and we'll look forward to chatting with you during the week on Twitter.